I'm here with Andrew Milligan, Head of Global Strategy at Standard Life Investments, and we're going to talk about the difficult UK environment and where you should have your money at the moment.
Good.
Well, one of the major discussion topics at the moment is the end of quantitative easing. Is it an end? Is it a pause? Do you think that's a threat to investors?
I think it is a major uncertainty for investors, because we have been through absolutely exceptional times in the course of the last year. We have not had such an experiment as the electronic printing of money in any country outside Japan in the post-war period. And we are not quite sure what the impact of that has been on a variety of markets. The Bank of England has changed its line several times on whether or not QE is or is not a success. And also, it's been tried in different ways in different countries. The US, Europe, and the UK have all tried different forms and are exiting in different periods. So it's no surprise at all that investors are paying considerable attention to this. First of all, as and when it ends, what is going to be the impact on bond yields? Were they artificially lowered? Will they rise? And then secondly, the question of the amount of liquidity which central banks have created in the world at the moment. Is that something that they can control, sterilise, bring back under control, or is this the start of a trend towards rather higher inflation, not just in the UK but in many other countries around the world? So yes, it's an issue which investors are looking at with considerable care and analysis, but we will find out from the central bankers in due course what some of the decisions are. Are they going to hold on to their assets? Are they going to sell them? How are they going to sterilise the liquidity they've put in? And then the markets can actually begin to make their minds up.
For the UK investor, is the fiscal situation in this country more or less important than the Bank of England's policy on interest rates and quantitative easing? Or should we be looking at both equally?
I think we have to look at both, and I think I'd answer your question by saying it's a matter of timing. The quantitative easing, any increases in interest rates, efforts by the Bank of England to boost money supply growth, those are particularly important this year and next year. We're coming out of the recession and the financial crisis. We're returning towards some semblance of normality in economic activity, and the Bank of England wants to begin that recovery process. Then we've got a period, say, lasting 5 years or so, where we're going to be having to deal with fiscal policy and all of the burdens that we know that we've built up. And although the government has announced a number of steps already in the pre-budget report last November, we've got the next budget, we've got a post-budget election, and a large number of the details, not just in terms of tax and spending, but the speed. Do we start in 2011? Do we try and delay it a little more and wait for growth in the economy? So I think the fiscal issue is something that's going to be overhanging the markets for a good 5 years or so. If you deal with some of the analysis and look at it, the fiscal pressures and their impact on bond yields going out in a few years' time could be absolutely immense. I mean, we're talking of 1 or 2% higher in bond yields. And in the short term, we're worrying about quantitative easing and the short-term impact of the withdrawal of that on bond yields. So the timing of those, I think, is something that is going to be of constant debate by investors, and the impact is something that we're certainly having to try and take into account in our portfolios.
So those factors mean that UK is a don't invest location and people should be looking overseas to more stable growth stories?
I'm not sure that there are any stable growth stories, and that's part of the difficulties that we see at the moment. One of the themes we've been emphasising in our house view is how country analysis is much, much, much more important. We had a period of time, 12, 18 months ago, when by and large all countries were performing the same way, going into recession, coming out of recession. But now we're beginning to see differentiation. Some countries did have less of a financial crisis. Some actually responded a lot better than the UK did in terms of the policies they put forward. Some have got closer links with China and therefore can grow more quickly. But I wouldn't say there's any stable growth prospects out there. I think we do have a convoy within the global economy led by, say, Australia, China, Korea, then the US and the UK probably in the middle, and then a number of the smaller European countries, Ireland, Spain, Greece, lagging behind. They're all progressing slowly, but if there are policy errors by the Chinese, if there are policy errors by the Americans, if there are policy errors by some of the European countries, any of those growth prospects could change quite quickly.
Basically, all investors are dealing with an awful lot of what-ifs hanging over them,
Absolutely.
Which makes investing at the moment particularly difficult. So
Yes.
where are you advising that people should have their money?
Well, I think the first point to make, and you've actually hinted at it in your question, is the need for scenario analysis. There are an awful lot of what-ifs out there. The possibility of a double-dip recession is low, but the possibility of the UK losing its AAA status is very low, but the possibility of a Eurozone crisis is low, but. So I think there's considerable advantage in doing scenario analysis, looking through the range of possibilities, accepting some, dismissing some, and then putting portfolios together. Underlying all of these issues, though, there are some certainties, not many, but some. One is it looks that inflation is going to remain very low for the next couple of years at least. Secondly, interest rates, even when they start rising, are not going to rise quickly, bearing in mind all of the growth and fiscal uncertainties we've been talking about. So one of the lines we've been taking, an investment theme, sustainable yield. There's steep yield curves, there's advantages in corporate bonds, we can see advantages in some equity paying companies, dividend paying companies, and of course commercial property in certain parts of the world, UK and Europe. So I think we can put together a portfolio of assets, credit, some government bond markets, some equity markets or sectors, some sectors of the commercial property market, and that is going to be giving you a good yield. And in a world of low inflation and low interest rates, I think that can provide some certainty. Then, depending how aggressive or risky an investor is, they can then decide whether or not they wish to take on board some more speculative elements, such as how am I going to take advantage of the global emerging markets, or how am I going to take advantage of the recovery in certain areas of the UK economy, say UK manufacturing with sterling so low. So I think sustainable yield is the core of a portfolio, and then around that you can see several satellite decisions that you take, bearing in mind what scenarios you've been thinking about and the results that you've come to as an investor.